The Monetary Policy Committee on Wednesday voted, although not unanimously, to keep rates unchanged at 6.25% for the repo rate and 6% for the reverse repo rate. The stance of monetary policy also remains neutral, although the Reserve Bank of India in its statement has acknowledged some downside that has emerged on the inflation side. We'll get to that in a minute. I first want to flag off the fact that this is the first decision by the MPC which came into place in September last year, which was not unanimous. Ravindra Dholakia, one of the external members, did not vote in favor of the decision. The statement doesn't make it clear what he wanted, whether he wanted a rate cut or something else, but the decision was taken with a 5-1 vote. The reason for that is that the inflation scenario has changed considerably between the last meeting and this meeting. Inflation numbers have been soft, coming in just under 3% for the month of April. The RBI acknowledges that this inflation softness is something that it hadn't anticipated. It's revised lower its inflation forecast and now says that inflation is projected to be in a range of 2 to 3.5% in the first half of FY18 and between 3.5 to 4.5% in the second half. It also says that risks on inflation are now quote-unquote evenly balanced. Step back a minute, this is a significant change from what they were saying earlier, where they said that risks to inflation are to the upside and they were projecting inflation to be between 4 and 5% over the course of the fiscal. Does that leave room for a rate cut perhaps in August? Well, there certainly seems to be some indication that that's not out of the window, because in the comments in the press conference that was held after the monetary policy release, Viral Acharya, Deputy Governor at the Reserve Bank of India, said that they could consider broader accommodation if data warrants, so they haven't ruled it out. So that's something that the market has held on to. There is also a mild change in the estimate for growth for the current year, 10 basis point reduction in the Reserve Bank of India's GVA estimate for the current fiscal. That's the broader monetary policy view, but there are a couple of other important things that were done. One in particular, the RBI is trying to give a big push to housing by reducing the risk weight on housing loans and bringing down the provisioning needs. This is keeping in conjunction with what the government has been trying to do, which is push housing. Many believe that housing is a sector which can have a multiplier effect, and the RBI is jumping in on that attempt to revive housing and then give a fillip to the economy.